Hello ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. Well, what a difference 24 hours can make. We've had the Bank of Japan intervening in markets, which we'll be taking a look at today. It was a big one, and it was secret too. And on top of that, we now have an Sp500 that closed way nicer than it was looking during the session. Yes, it turned around over 2%, and as you can see here, we have a massive switch in overall sentiment here on the markets. Specifically, the long leg doji and this rejection candle have been closed above. Does this finally open up the squeezes that we've discussed here for the last couple of weeks? It's certainly starting to look that way, and in today's video, we'll go through everything that's happened in the markets in the last 24 hours, and of course, it's going to be happening in a massive week of earnings, because yes, it's Apple, Microsoft, Amazon, and Google week coming up, guys. See you soon. Well, welcome back everybody to the Daily Show. In today's video, we're talking about the news, the macro data, the lead indicators, and of course, the big earnings week ahead in the US stock market. On top of that, we've got the key levels that you should be watching throughout the next week. The yen surges amid signals that Japan has intervened again in the FX market. Yeah, that was probably them through the Friday session. They did it during a liquid time, and boy, oh boy, did they send some massive moves in the markets across the board. The yen jumped as much as 2.7% versus the dollar during US trading hours. We'll take a look at that later and what it looks like on a chart. Then also we have, of course, what this means, because they're going to continue to come under pressure. This is the second time they've intervened in literally a week. Now, let's talk about federal funds rates, because so many people are not on top of this story. It's important to note this. We're starting to move into that 5% territory come April and May of 2023. But after the Friday session, these dropped a little bit. We'll take a look at those a little bit later on. But remember, understanding where the forward yield curve is, that's where interest rates are expected to be in 6 months' time, in 12 months' time, is very important to each and every one of you out there. It could be one of the biggest lead signals for certain asset classes around the world. Let's talk about sentiment. It's still negative. It's still in the gutter. 56, 55, 55, very bearish across the board. The market managed to do a maximum Payne move on this, which was the third week expiration. They literally managed to make all the options expire at the pretty much perfect level for them to make maximum profit. Maximum Payne for retail, maximum Payne for options buyers. But at the same time, it was a very profitable week for Wall Street. You can just see it there when we take a look at options later on. Sentiment-specific models are nearing maximum pessimism. So we've seen this a few times, and we've talked about this chart a few times. Only 2% of the market period usually we ever get underneath this pessimism level. And the annualized returns from this level are ridiculous. Now, that doesn't mean that it always works, but of course, statistically, it's ridiculous how much more positive markets tend to be once they reach these types of levels. Yes, optimism is really bad, but in some cases, things are starting to turn around. What about XLK? Now, of course, we know the technology sector generally drives us out of previous dumps in markets, and we've got kind of two similarities with 2022 so far, specifically this one that we had over here, which began that June into July rally. So we managed to meet that pessimism kind of level. We've done it again, and we've shifted to above 55. This generally means that we're making a big shift, and this occurred basically a week or two ago. So if we take a look at the stats, let's ignore what's happening here. Let's take those readings. We've got a few data sets here, and what you'll notice is a month and 2 months later, historically, when getting these types of readings, the XLK, so the technology sector, has been bullish after this. So again, it could be another one of those little bit of bullish signals that shows us this squeeze is on. My favorite one is always looking at contracting stocks, because it shows what's going on underneath the S&P 500. And recently, when the S&P 500 made a new low, we didn't see anywhere near the same amount of stocks hitting new lows. Now, this is one of the best indicators, because not only is it pretty accurate towards the bull side as divergence, but we have a lot of data sets from it over the last 100 years. And as we know, we got this about a week ago, so we're sitting around here, and we're sitting in that kind of semi-positive territory towards a squeeze idea with potentially some weakness coming in in a month or basically 2 to 3 months. Would that be in line with everything we've discussed so far? It certainly could be. So again, squeeze potential there. It's the right time of year for it to occur. Seasonality is very strong at the back end of October into November across midterm years and across realistically any year. This is usually the period where we get that super strength, that pull that comes through. And if you're thinking about bear markets in general, here's 200 years of pullback data for you to pause the video on. We've got so much to go through. We've even got the areas here in terms of the most similar types of market conditions that we've had in the past. 2007, obviously this was where we saw that cataclysmic event, but in 73, 61, 65, and 2001, which are the most correlated right now, these were all squeeze positionals. So this was literally where we saw turnarounds and we saw squeezes come through. The earnings season is well upon us, and of course, beats rate is currently looking at 68%, beats 145, misses 68. But we're entering into the big week, and we'll take a look at that very soon. This is the week where we get that Amazon, Apple, Microsoft, all those types of ones. But what happened on the Friday session was pretty interesting. It was a across the board rally. We saw the Dow Jones, the Nasdaq, the Sp500, and the Russell 2000 all do 2+%. And it realistically came almost out of nowhere on the charts. And as I mentioned in the previous video, it was a kind of tough day to trade unless you were going for that options maximum pain. You didn't really have a huge amount of support, a huge amount of demands, or any of the normal things that you'd look for statistical reliability. But yeah, that's what the market did. If we have a look at the last 5 days of trade, you can see it was kind of up, down, all around. At one point, we were only up 1%, but those rallies have solidified very, very strong gains throughout all of the major markets. And it was one of the better weeks we've seen since June. Again, closing at these highs, closing where it did, is very strong for the market, and most pullbacks you would think now should be met by buyer demand, at least temporarily. What about the sectors? Were they the right sectors to go? Well, we saw metals recovering. Nice, that's good. We saw semiconductors coming out with a nice recovery. Again, very, very strong. Technology was good, and that was coming with it. Even consumer discretionary was doing okay. And the notable ones were seeing the defensive sectors do not as well. This is exactly what you want to see when you're talking about a recovery in a market. You do not want XLP and XLU leading the charge. If that's happening, yeah, the market is literally rotating into defensives, which we'll now have to spot each and every day over the next couple of weeks so we can see whether they are doing that again. Because if they're going into defensives, we have to pay a lot of attention. So just before we jump into the charts, guys, and have a look at everything for the week ahead in terms of the key levels, I just want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, I've got Tiger Brokers up here, and I've specifically selected the economic calendar because this is the big week. As we mentioned before, it's earnings season, and when do we want to be paying attention most to earnings season? Well, in general, during the week of Apple and Alphabet and Microsoft and all those others. So you can see here that Tiger Brokers has the ability to select the US market, dividends, IPOs, and report announcements, and you can view them on the daily. So you can see here whether they're coming out pre-market or post-market, what the stocks are that are coming out. You can view it monthly if you like to view a nice calendar like this and then drop down each one, or of course weekly. Now what I've done here is I've created a little watch list just with some of the big names coming out this week. And as you can see here, it shows you those data. So you've got here Tuesday, you've got Google and Microsoft. Then we've got Wednesday, we've got Apple. Then Thursday, we've got Amazon. And of course, there's a lot more around this. But I've done this by just selecting a little watch list, collecting it. And this can be great for traders out there and investors because you don't want to go through an entire economic calendar. It's so annoying. But you might specifically want to have some smaller companies that you have, some larger companies that you have, chuck them in the watch list, and then they'll come up here and you can put them on the monthly view as well. This is something that's pretty unique. Some brokers have it, most don't, and I really like this feature. Remember as well as all the news from watch list as well can be had here where you can select just your particular stocks and it will come up for the news for those. And we've got headline news as well coming out of the Tiger Brokers platform at this stage with a bunch of premium content as well being delivered to you. In a time of complete uncertainty in 2022, this is what you need. For all of the Australian and New Zealand audience out there, Tiger Brokers has a special offer for you guys, 40 extra zip stock when you fund the account with 1 cent or more. And at this stage, there's also a bunch of special offers for other people around the world. So check the links in the description if you're interested in finding out more about Tiger Brokers. So let's now take a look at the charts and the key levels that we should be watching for the week ahead. And we'll start off here with the yen. I just want to quickly reiterate, of course, they're trying to hold yields down here. 0.25% was reached. You can see it was breached as well through the last couple of sessions. But more notably, this is the intervention that the Bank of Japan caused, and it was massive. Take a look at this. They got in there. A lot of people speculated they'd hit it around 150, and then they've just slammed it at about 152 and just had to push that thing down. This must be costing the Bank of Japan billions and trillions of dollars of yen. They're obviously doing this to try to keep their policy alive, and this is why you don't trade pegged currencies that have manipulation in them. Look, if you were trying to short, the problem is you might have been trying to short a long time ago. You got squeezed out. Most people would have thought 150 was the golden number. It didn't happen that way, guys. It went to 152 and then just got crushed down to 147. Expect this to continue to be the story over the next coming months. If inflation doesn't peak, Bank of Japan could be in serious problems, and it could be a Euro-Swiss style moment, which I've shared on this channel before. Go and have a look at Euro-Swiss on your charts. In about 3 minutes, we lost about 40 cents on the currency plus. So you've got to be very careful, and Japanese yen pairs are not for risk takers right now. I mean, for unrisked people that don't want to take risks, because this is just way too dangerous for most people to get involved in. VIX volatility actually dropped 29.68. That makes, some expectations. Of course, we had some of the biggest options expirations happening this month in October. A lot of puts expired worthless. The VIX was held down probably artificially due to that. And we're still looking for the same thing over the longer term. We'd love to see a nice spike in the VIX with a 40 plus to really solidify that we've hit that max fear kind of moment. 2022 might have been scary so far, but we haven't had that kind of normal fear that comes through with the VIX to solidify bottoms. US 2-year did drop through the session. It spiked and then came back down to 4.479. Let's have a look at some of the yields here. I'll just bring up some of them. 5-year is at 4.34%. 10-year at 4.2. Again, you can see they've all dropped. And most notably, we got a drop across from hitting 5%. So our April, May kind of ones, they dropped to 4.87. And more importantly, we got another cut that's been showing here, 4.65. So basically, we went down over the long-term yield curve by around 0.4% overall in terms of what the expectations are. That's a big tick in terms of why the markets were able to go green through the Friday session. Why did it happen? Look, who knows really? The main point is that's what's occurring, and we have to, of course, trade accordingly. Let's have a look at high yield bonds. High yield bonds bounced through the session. Again, that's good. We didn't get a new low on high yields yet. So that means that at this stage, they're going with the market. That's, of course, what you want to see. The long-term bond yields that I saw were doing pretty well overall. So the bond indicators that I have were basically saying the market's rally was expected, or at least it should be going with it. And corporate bonds also improved on the day. Let's take a look at the damage here. We said we need to watch the dollar index. This was the one that I believe broke the camel's back in terms of overall movements. We moved through this level of supply. We tapped into that previous level over here, and we just slammed it down. We got intervention from the Bank of Japan during the liquid hours, and they pushed it all the way underneath here. Now, this is a fairly significant change because we've now made a new low underneath this low. So this is a lower low. That should solidify weakness, further weakness for the dollar over the next week. And while there may be some recoveries through this Bank of Japan intervention, there's a good chance that we may make it down to this 111. And of course, what does that mean? Well, it's usually correlated with a lot of pairs, but specifically the stock market should be able to move up after all of this. Let's have a look at the euro. What do we expect from the euro, which is kind of like the sister pair? This is usually the one people trade in relation to the dollar index. Well, it rallied very heavily, as you can see here, and it broke through this previous little manipulation zone over in this zone or area. I'd love to see it take this area, but realistically, I think that the market will come back in terms of the euro And somewhere between this 98 and kind of 97.60 zone, we should have some buyers, some demand coming back in for euros at this point, and of course weakness in the dollar hopefully to ensue. We have some take profit zones, the parity level, so that's 1 for the euro and the US dollar, and this level that we've been looking at for ages now, which sits around 99.20. They're all open for the week ahead, and actually this intervention, this movement could open up quite a lot of nice trades should the right things occur. And at this stage, I would love to see something like this occur. And then of course, movement into here and here would be fantastic. So I really like the idea of the euro pulling back in the next week and then finding some buyers in those areas. Gold's very similar, actually looks better than it did. Gold bounced off these lows. It broke through the downward trend line that's kind of been consistent all the way through here. And it, more importantly, snapped off this level. So it made a lower low here, and then it made a higher high. So again, the idea is weakness into ideal buying strength, somewhere around this 1635 level. And then we move towards some buys here on gold. It's funny how in only 24 hours, things can really change on the charts. And all of a sudden, we're in a much better position from a gold perspective. Let's have a look at the close here. The reason why you can feel a little bit better about gold is when you look at these 2 weekly closes. Notice this, a big wick followed by a big wick. That means that whatever's here is buying it. Now, can you tell this on the left-hand side? Not easily. There was a little bit of purchasing previously through this area. It was less clear than, of course, the ones I have loaded down here. But now we have more information. We have 2 big buy zones in terms of how the gold has been being purchased. The demand is clearly there. If we get pullbacks, hopefully that demand will come back in and show it. Now, oil has been pretty nasty. Overall, you would still think it's kind of looking towards that negative side. I do have some positive kind of alerts though that you would set for this week, looking for that 87.20. If it breaks through there, the potential is really strong for us to move back into 90, because that would be like a little inverse head and shoulders here. It would also solidify that this market didn't break out of that downward trend for no reason. Remember, that did happen. For now though, market weakness is still possible and very probable for oil. Even with this overall, we've kind of got 2 counter signals. Here, we go towards the negative side, which it did. And then now we've got that kind of counter to the negative. I would say this is neutral, in my opinion, with the strength above here and overall still in the downward trend. So therefore, the shorts would still be more powerful until we break through this 87.25. But yeah, I would probably stay away from oil. I've already said this many times. Oil sometimes provides good trades, but overall, I'm still negative on it over the next 3 to 6 months. I do think that oil can fall a little bit further, even with the OPEC manipulation. Just demand destruction should be underway at some point very soon. It's already started, of course. XLY, XLP, as we move into the stock markets here and talk about the indices, this shows us that consumer discretionary was beating staples, which is exactly what you want to see with a rally. Usually you want basically risk on, not risk off. XLP is risk off, XLY is risk on. Hopefully this indicator can continue to go bullish if we start squeezing. What about Tesla? Well, Tesla bounced off this level again. And for people that have been buying pretty religiously around this 205, 206, I guess you'd be pretty happy with the session. Ended up 3.45%. We've still got a gap to close that's here on Tesla. Now, as we know, the earnings announcement came out and the market didn't like it initially. And then now it's bought it up because, of course, everything turned. But yeah, with Tesla, I'm still not discounting in the future this 180 level. I'm still going to hold it there in terms of just having an alert just in case. We have a lot of unfilled gaps. There's another one here as well, or actually here, for Tesla. So a lot of unfilled gaps that we could fill if we start to squeeze, and potentially something like this could be very possible for Tesla moving forward. But for now, let's have a look at the 2 hour. I mean, that was a decent base and it took the lows. And at this point, if as long as the stock market recovers, we should be okay. Apple also almost hit our alert for taking out that high, and it did do so and actually closed right on it. So again, that's a slight positive coming into this week's earnings. As we know, earnings will be the focus this week, along with some of the other central banks. The ECB, the Bank of Japan, they're coming out later on in the week coming forward. But yeah, very, very nice move here from Apple. It bounced above. Let's have a look at the daily close. You can see it's daily closed above those previous wicks, and that kind of solidifies some form of optimism leading into this big week of earnings season. It's going to be massive. Google as well, holding as best it can. Probably alerts above that 104 kind of 80 or 104.60 zone. We've moved down to this area. We've now filled the gaps that were here. So the gaps that were there have been filled. That's awesome. And now we're forming a little bit of base ahead of the earnings. Can Alphabet actually move around? Well, Snap would say no. We'll find out whether they can do the good result. Amazon also not really struggling too much. It did bounce back up here. You can see that it's starting to form a potential inverse head and shoulders on the smaller time frames. We'll continue to follow this. Earnings is only 6 days away. I personally feel like Amazon's going to be a big one because it shows us consumer discretionary. It shows us whether people are still spending. Now, some banks have come out and said that people are still spending, which probably means debt's getting really bad, because I don't think people are spending with their own money, guys. I think they're spending it on debt because they get used to living a certain lifestyle over the COVID pandemic. And yeah, that could be unfortunate long term, but here is where Amazon sits. And of course, it does mean potentially more pain to come from the Fed. The UK 100, the FTSE, still setting up quite nicely. We haven't broken the high nor the low, so we're stuck in a range. That's fine for now. We'll continue to watch the FTSE. As you know, I want to see what way that breaks. And the dollar, the DAX is moving towards that downward trend line. So we're going to see if we can synergize the DAX together with the US market for a potential squeeze into drop scenario. That's what we're looking for here a lot in the stock market. The US 100, a nice close for it. Look at this. Closing above a wick like this one, a big rejection like this, is usually a fairly positive signal. Over here, we didn't quite close above it. Here we did. Can we have any other signals here that have been recent so I can show you? Hopefully we've got one over here. Here's one that closed above 2 dojis. Again, that continued on with the process. Here's one that didn't close quite above, didn't do it. I'm sure there's some somewhere, but basically these are the types of candles that you want to see. A closure above. The close is key, we often say on this channel. It closed at the anchored VWAP, which we used last time to find a short position. It rallied around and it was pretty significant. Let's have a look at the 1 hour here. I think this was kind of difficult to get hold of unless you were watching it through the session and you saw it take this high and then you made the decision, okay, pullbacks will be met by buy demand, which is what happened. Unless you were there during the session, you would have usually been looking for the market to come back into this equilibrium level, back into that 10,800, which is what we discussed. But the rally was too big. The Bank of Japan, all these other things occurring, and the market just squeezed the living hell out of it, most likely for options expiration, which we'll look at soon. For the week ahead, the levels that we'd be watching, we still want to pay some attention to this level here, which is around 10,000 or 11,450 for the NASDAQ. Could be some weakness there, followed by hopefully some bull demand. And ideally, we move to 12,000. That's where we'd love to see a squeeze. And that will coincide very nicely with the S&P that we look at soon. Here is the long leg doji. Here is, of course, the daily close. And as we know, bang, we took both of those out. Again, that's a fairly positive signal. Some people are going to look at this now and they're going to see it and they're going to say, wow, does that look like an inverse head and shoulders? Left shoulder, head, right shoulder. Very possible, guys. And if we break, the distance from this would be generally this distance. And what I want to do, and I haven't done this, so we'll just see whether it does proof. It does proof pretty well. So sometimes when patterns proof, that is, they look like they effectively move into a zone that you already expect, it can be a very good signal. When markets have pattern proof, I usually like that. This one does have pattern proof for this idea, and that would be a second squeeze scenario. That would be that 4,100, and man, oh man, would that put pain on so many people. I'll just quickly explain why that's possible. If we have a look here, look at this downward trend. So this is 1, 2, 3. Remember, if we do push up here, we're not going to push directly in a vertical line. So it's going to be like this, blah, blah, blah. Imagine if we did this, hit this level in a few weeks, if not a month or something like that, and then we hit that downward trend line. Could that be a signal or a very serious thing? Absolutely. This also could bring in a whole bunch of potential Elliott wave concepts as well. So we'll talk about that, especially if we break past 3802. If I was setting alerts for this week, I'd have an alert for the high. I'd obviously have an alert for the 3880 zone. I think that's going to be super critical for potential squeezes. We want to have the alert in here, though I doubt that hits in a week. And yeah, I mean, it's a pretty serious turnaround. Again, fairly difficult to get. Let's have a look here at the US 500 futures just to reiterate that. So here's the daily. We'll go down to the 1 hour. And again, the only way to really get this was to be watching through the session and to see it break this structure early on. And then you got that second chance draw pullback, which you could have then longed up. Other than that, picking this level up, it didn't quite get to what we thought. We definitely were thinking 36, kind of 20, 30, 35, 80, more this area down here was where the market would go to. And it just turned a little bit too fast for a lot of people out there. It was going for that squeeze. It was going for that maximum pain. The key levels to watch for this week ahead will be this little wick high. I believe that could hold some keys here. So I'm going to watch that one, which will be sitting right there. I do think that based on the daily close, there's a good chance that pullbacks will be met by bull demand. It's a big switch, what happened here. It no doubt caught a lot of people off guard, and it could continue to a nice squeeze level. Then we go to 3880, 3920, a critical supply level. And of course, then we've got that big 4100, which won't happen, you would think, over the next week. But earnings will ultimately decide how this market wants to turn. Let's talk about maximum pain. It did it very well. I mean, they were sneaky. 4.8 million units of open interest amount, options expiration here. And as we can see, the poor 330s, the 340s, they didn't make any money. The 350s, the 360s. And then at the end of the week, we saw some battles between the calls and the puts sitting around 370 strike and 375. And what did the market do? It went just above 375. Man, they are sneaky. They are nasty. Always never discount third week options expiration. I don't see too many other people mention this, but this is the key options expiration. And if you're going to ever apply max pain, statistically, this is the week to do it in. Most weeks, doesn't really work. But in the third week, if it seems like it's possible, then they'll have a go at it, especially if there's a lot of money on the table. And all these poor people, all the options expired worthless. And again, Wall Street makes the money in this case, or at least whoever the hell was selling those ones. Let's talk about Bitcoin. Nice kind of close here for it. Nice bullish hammer. Now, I'm not really too keen on the level for Bitcoin. And I know I've said this a bit because I've kind of maintained my longer term concepts on here, which is Bitcoin should hopefully fall between 83 and 86%, which would put us between 11.5K and 9.5K. And that's based on other pullbacks during crypto winters. But at this stage, we are literally at equilibrium. We are in the middle of this range, the most traded zone. To me, that doesn't really give you much edge. I like to trade the extreme zones to the equilibrium, and that's not where we are at this point. If we look at the calendar for the week ahead, we have a whole bunch of information coming out, though most of it is not very interesting for US players. We've got Flash Services PMI 945 New York time. That's coming out there on the Monday. Then we scroll down through here. Not too much, just a bunch of other countries stuff. And then we keep going down. We have monetary policy statement coming out from the Euro on Thursday. Of course, that's going to be big. We've got the Bank of Canada coming out as well. And then we've got the ECB press conference and the Bank of Japan outlook report. That'll be interesting. When they say tentative, they just make up a time. But generally, if you're Australian, it's around 2 to 3 p.m. AEDT in the afternoon, usually when they have a bit of a chat about things. And then we go down here, Treasury Currency Report and the Core PCE Price Index, 8:30 a.m. New York time on Friday. So look, there's a scattering of news, mostly from other central banks around the world. The Bank of Japan report could be interesting. ECB also could be interesting. And then we move into, of course, the rest of it. Now, big thank you to the sponsor of today's video, which is, of course, Tiger Brokers. If you're interested in signing up with them, remember they have an extra 40 zip stock for the New Zealand and Australian audience out there. But for everyone else, if you're interested in getting access to some of their tools, plus some special offers, check the links in the description down below. Have a great weekend, guys. I hope everyone had an okay week. And of course, there's always a new opportunity around the corner. Remember, never feel FOMO. There's always another opportunity. Remember to subscribe, smash that like button. We'll see you in the next one. Bye for now.